You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is, of course, the program designed for busy financial advisors who want to try to find ways to incorporate options into their client portfolios. It's also for those of you out there who are looking for a financial advisor and want to know, hey, what should this guy know that I'm paying so much money to? What skill sets should he have when he's actually managing my money? We run those down for you here as well, so you can arm yourself when you're going into those conversations with those advisors. Hey, do you know this? Can you do this? Can you do that? It's a good thing to arm yourself with when you're going into those conversations. My name is Mark Longo from theoptionsinsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. Of course, if you haven't done so already, you might be interested. Check out the most recent addition to the network. That is, of course, our Trading Tech Talk show. We talk about all the cool tech that is powering the trades that you are making right now. And if that's not enough, particularly on the tech side, we also just launched the Options Insider Radio Network mobile app. You can find it in your app store of choice. Head on over to Google Play or the iTunes App Store. We even made a version for you Amazon fans. Check out the Amazon App Store. You can download it for all of your different Kindle Fire devices. 3 different versions. Just check out the Options Insider Radio Network mobile app. Of course, you can find the Advisor's Option in there, as well as all the other fine programs we produce on the network. You can stream the shows from anywhere. You can download them and listen to them later for offline listening on the plane or on the subway. And even better, you can get in touch with us very easily through the app. Just click on the Contact tab. All sorts of great ways for you guys to send in your comments and questions for your favorite show. So check it out, the Options Insider Radio Network app in your app store of choice. All right. And joining me on the Advisor's Option program today are my 2 cohorts, my partners in crime here on the old Advisor's Option, starting off with the man beaming in all the way from scenic and perhaps even sunny compared to Chicago, Durango, Colorado. He is the co-founder of Swan Wealth Advisors, Mr. Randy Swan. Randy, welcome back to the program, sir.
Thanks. It's great to be here. I'm in that phase right now where I'm trying to decide, do I want it to still be winter and get more skiing in, or do I want spring to start coming? I think I've got some skiing left in me, so I'm pulling for more snow.
Well, given the fact that you live in Colorado, which is a bit of a skiing mecca, I'm going to guess which way you fall on that pendulum. For us here in Chicago, we've been kind of inundated with snow for the better part of the last few months. So I think we can all kind of collectively vote here to say, hey, no more of that. But hey, perhaps that's me. I'm sure there are a few diehards out there who want some more snow. Perhaps amongst them is none other than Mr. Mike Cavanaugh from RCM Wealth Advisors and RCM Asset Management. Mr. Cavanaugh, where do you fall in the great snow or no snow debate?
I have to say that Randy has a competitive advantage of wanting more snow because he actually has mountains to go with that snow. We don't have that unless you're an avid snowmobiler or ice fisherman. That it's time for the snow to go. We need it to warm up here. But outside of that, everything else is great. It's a whopping 40 degrees today, and we're getting dumped on with rain. So if you are sick of the snow, at least it would probably have been about 12 more inches of snow because it's really raining out there.
That's a good point. And indeed, we are here in the Midwest where there pretty much aren't any mountains anywhere to be seen. So you're right. The snow has limited utility here, unless you want to make a lot of snowmen, I guess. That's about it. All right. And before we keep going on with our weather report here on the show, we're going to dive right on into our first segment, our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to Options 101. This is, of course, the portion of the show where we break down some options concepts in some plain English, so you, the advisor, can make heads or tails of them, and indeed you, the potential advisor client, can also make some sense of them as well. And as we were looking throughout the history of this show and all the different topics we've discussed and trying to think of what we should hit on for today's episode, we kind of came back to an interesting strategy that we've kind of touched on because it involves and is the component of so many other strategies that we've touched on it tangentially in the past, but we've never actually devoted a full episode to exploring its many nuances. And that is, of course, the straddle and its kind of related cousin / brother, the strangle. These are two very basic type positions, and yet they are very important for a variety of reasons that we're going to get into here on the old episode. So let's start off with just a basic rundown of what we're talking about here. And indeed, if you want to go back and familiarize yourself a little more with spreads in general, go check out all of our various spread episodes we've done here on the show, including spreads with wings and basic spreads. And so you can really get a better example of the different types of spreads that are out there. And we do touch on straddles and strangles a little bit in those episodes. And then come on into this one, and you'll be well prepared for our straddle and strangle discussion. So let's start off with the meat of our discussion today, quite literally. That is indeed the straddle. You may have seen this concept bandied about in a variety of different educational scenarios. That's because a lot of firms over the years have used a salient feature of the straddle as a way to entice clients. You might have seen a lot of promotions over the years. Hey, come here and make money in any market condition using options. And that what they're usually hawking when they're promoting that is the straddle. And they are technically right. The straddle does do that. Because what is a straddle? Well, it's a very basic position. Usually it's at the money, but it could be a little bit in the money, a little bit out the money. But what you're doing is either you're buying or you're selling a call and a put on the same strike. Now, let's walk through a little basic example to give you an idea of what we're talking about here. Let's say our favorite name, good old XYZ, a name we've all just shed tears over in the past because it's taken so much money from us. But good old XYZ, let's say it's trading for $50. And you're looking at it, you say, I think this thing's going to move, but I'm not really sure which way. It could drop $5, it could rally $5. I don't really know what's going to happen with this thing. So one potential option, pun intended, that you could pursue is to buy a straddle, go long a straddle. What does that involve? Well, in this case, we're looking at an at-the-money straddle, so you're going to buy the 50 call and the 50 put. Those are both on the same strike. Let's say in this example, they're trading for about $2 each. So you spend $4 for that straddle because you're buying both. Now, if you think about that intuitively, what does that give you? That gives you a call, which is a bullish position, and a put, that is a bearish position. So pretty much anywhere that underlying moves away from that 50 strike is going to benefit you. So if it rallies beyond, let's say in this case, you spent $4 on that straddle. So your break even point would be $54 to the upside, $46 to the downside. If the straddle moves beyond those levels in either direction, you're going to profit. And it sounds very simple. It sounds like, hey, why wouldn't I do that? That's a great trade. I should be doing that all day long. Those guys with the infomercials are right. I can't make money in any market condition. And there's a couple drawbacks that should become readily apparent when you start thinking about the straddle up front. The first off is the fact that you're buying two options, not just one. So therefore, your premium exposure is going to be 2x what it would be just a single leg type trade. And in addition, all the things we talked about on the show in the past, time decay, you're going to be suffering tremendously from time decay and from theta with these positions because you're spending so much upfront for the position. So what happens with the straddle is that technically it is correct. If it moves in any direction, you can profit. But what happens is because you're spending so much upfront, you end up seeing that position decay quite a bit every day. And so it becomes a race against the clock, even more so than it is with traditional options positions, for that underlying to move and for it to start paying off before that straddle decays to the point where you've lost a substantial amount of money. And that's really where the difficulty comes in when you're trading a long straddle in particular, because it's a constant race against decay to try to make this thing work. And then you have a lot of scenarios, or what do you do if the underlying only rallies $2 in one direction? Or then what do? You made back part of your money. Do you sell it? That gets into adjustments. It becomes a very, very tricky scenario to really manage when you're looking at that. Of course, the flip side of that is indeed the short straddle. It's the same exact scenario we just walked through. Just flip the coin, flip the script. Instead of buying that straddle for $4, you're going to sell it for $4. And so now you're in a position where you want the underlying to stay put. You want it to hover right at that 50 strike to take advantage of all the things we were just talking about. All that high decay, you want to collect it, so the longer it stays at 50, the better you're going to be. And also, if it just stays there and doesn't move aggressively, you're going to collect decay every day, and it could work out in your favor. And again, you want it to stay between 46 and 54. That's where your break-even points, that's where your pain points are in that trade. If it starts moving beyond that, of course, that can get pretty pricey, pretty expensive, pretty dangerous for you in that area. Now, Mike, I know you deal with a wide variety of different clients, retail and others, and I'd imagine somewhere in those conversations, the concept of the straddle has come up. Maybe you've been approached by a client who says, "Hey, I saw this on an infomercial. I can make money in any direction." So what's your take on the straddle, both long and short? Do you use them? Are you a fan of this trade? Are you not? What's your take here on the straddle in general?
Yeah, no, and you did a great job of giving us a descriptive overview of what they are. Yeah, I've felt for a long time that there's been people that get introduced to option trading in the wrong venue, from the wrong mediums. Like you pointed out, if you go to one of the Weekend Warrior seminars and somebody's pointing out you can make money in any direction, but yeah, I mean, they never say you can lose money in any direction either. And the things to point out with this strategy aren't as much the direction. That's just one aspect of it. The different pricing components of the option need to be understood when you're trading any options, but especially with a long or short straddle, because there's so much premium. It's the most amount of premium in a straddle is the at the money call and at the money put. Those are the juiciest options. It's all extrinsic. There's no intrinsic value if it's right on the strike at the money. So they're the most expensive types of options. So you need to know all the different pricing components. What's the delta effect? What's the gamma effect? What's the theta effect? What's the vega effect? People don't get into row all the time, but it doesn't kill you the further out you go. There's a larger, like in time, there's a larger impact in row. But just wrapping your head around the pricing components and knowing how you can lose money and how you can make money with the straddle is important before you dive into it. How I always tell people to start with a long straddle to help it as like an analytical tool is just to kind of look at it, because it's a great measurement of the implied volatility in the underlying that you're looking at. And since we all love XYZ, it's probably the most popular education-based stock out there, so to speak. If XYZ is trading at 100 and the at the money, the 100 put and the front month is trading at $7, and the at the money front month call is trading at, let's say, $5. You add those together, $7 plus $5 is $12. And basically what the implied volatility in XYZ is saying at that time is the 1 day movement in that stock could be anywhere from up $12 to down $12. And if you guys hear any noise in the background, I'm on the trade desk right now, and the USA is playing Canada in the Olympics in hockey, and they're up 2-1. So if you hear any, it's the women's hockey. So if you hear any noise in the background, I'm trying my best to mute it out. But
it's all those darn Canadians on the RCM trade desk.
30 traders that are watching the USA women's hockey Olympic game right now. It was an empty net. We almost scored. Anyway, so using that straddle, the at the money front month straddle is a good way to start understanding options. But, from an implied volatility aspect, it's a great tool to monitor, the different types of, option plays that you're looking at to say what the market expects from a 1 day movement in the underlying.
Yeah, that's a good point. And, that gets into another use case for straddles that goes beyond just trading them, which is the information they can provide to you. You see, particularly around earnings season, a lot of people hemming and hawing about conference calls and whisper numbers and things like that. But for a lot of professionals, they really kind of throw all that stuff aside and they go to look at what the options market is actually predicting for a move ahead of a big announcement like earnings or a crop report, whatever the case may be, because that's where real money is on the line. So real money is trading. And what they will typically look at to gauge that sentiment is the at-the-money straddle in whatever month the earnings is going to take place. So if you see a name about to go into an earnings announcement and the front month or even indeed the front week often straddle is trading for $5, then guess what? The market is expecting a move, could be up or down, either direction, of about $5. And that should give you a decent sentiment, a decent gauge for what the market, what real dollars are actually predicting in the marketplace. And you can use that information, even if you don't trade it, you can use that information when planning your own strategies. Now, Randy, I know you guys do a lot of overlays, not so much with the straddles, but what's your take in general on the utility or perhaps the lack of utility in a straddle, both long and indeed to the dark side, the short side?
Well, I'll give you a couple examples of how we use it, but we would use something like this using a short straddle combined with a long strangle to form an iron butterfly. That's one of our bread and butter trades that we use at Swan. I would also point out that the example that you did a good job of explaining and what you're expecting when you're long or short a straddle in terms of a certain required movement, but also just to point out the exposure that you have either way in terms of volatility side. So time decay is a big component of that. If you're long a straddle, you're obviously hoping the market moves quickly and moves in a large enough distance for you to profit, but you're also making a bet on volatility potentially staying flat or even increasing. That's just an additional way that you could actually make money from the trade. Conversely, if you're short the straddle, you're making a bet somewhat on volatility, either staying flat or going down, and hopefully having the market or the price of the underlying stay within a relative range.
The iron butterfly, one of my own personal favorites as well, Randy. I think we can get to that in a little bit. And indeed, if you want refreshers on all these different topics like the iron butterflies and indeed, like Mike mentioned earlier, implied volatility, surf on over to theoptionsinsider.com. Click on the radio network tab. You can see all the archives there for the advisor's option. Of course, you can find them iTunes, Stitcher, wherever else you find this program, and click on the archives and you can go check out our Spreads with Wings episode that we did last year back in August. So you can learn more about iron butterflies and flies and things like that. And then we also had the episode we did on volatility back in February, almost exactly a year ago. Actually, about exactly a year ago, February 20th of last year, where we get into things like implied volatility. Now, Randy mentioned the strangle and how it can be used in conjunction with the straddle, and that is indeed what we're going to get to next. It's just kind of the stepsister, the cousin, whatever you want to call it, to the straddle, and it is the strangle, and it is exactly what it sounds like. It is a position that kind of strangles a particular underlying that you're looking at. Now, you may look at XYZ again in that same scenario, and it's trading for $50, and you may think, again, hey, I think it's going to move, but I'm not so confident in that it's going to move a ton that I really want to risk a lot of that at the money premium. I want to pay all that decay, all that premium. Remember, the at the money strike, like Mike said, is where all the implied volatility juice is. It's also where you're going to experience the maximum rate of theta, the maximum decay. So if you're loading up on a bunch of at the money options, guess what? Decay is not going to be your friend. It is going to be your enemy. And you're going to experience it much more rapidly than if you migrated a little bit away from the at the money strikes. And that's kind of what the strangle attempts to take advantage of. This involves buying indeed a call and a put. So you have that same directional exposure in either direction, but you're not doing it on the same strike. You're doing it in different strikes. And typically that involves an out-of-the-money call and an out-of-the-money put. It could be the other way. It could be what's called a gut strangle, but it's not very common. You're not going to see many in-the-money calls and in-the-money puts purchased on a particular name. You're going to see mostly the other way, the out-of-the-money call and put. So let's walk through an example of the strangle here. Say same exact level, XYZ. Trading 450 again, everyone's favorite name there. And you're looking at it and you're a little less certain, but you think there's going to be some moving. But you don't want to maybe risk as much, or maybe you think the other way, you think it's going to move a lot, and you want to just be able to capitalize on the outside of that move. Again, either way, you don't want to risk a lot of premium up front. That's where the strangle becomes your friend. So instead of buying that 50 call and 50 put and spending $4, you can go the other way. Buy that 55 call, $5 out of the money. And let's say in this example, that's trading for $1. And then the 45 put, $5 out of the money the other direction. In this example, that's also trading for $1. So now you spent $2 instead of $4. So your premium outlay right off the bat, 50% less. So you can see the instant savings right there. You're also going to suffer a little bit less from decay in terms of the rate of decay. These are still out of the money options, so they're nothing but extrinsic value. So they will decay to zero if nothing happens. But the rate of decay will be a little bit less because you're not trading the at-the-money strikes. And so, therefore, you can see some of the advantages of this strategy is a little bit less outlay up front. The downsides, again, this underlying's really got to move for this thing to start paying off. This thing, it starts rallying. You spent $2, so effectively you need this thing to move to $43 or $57 now for it to break even for you. So that's a substantial move. So if you're looking at just the long straddle, or excuse me, just the long strangle by itself, you can see some of the cons of that, which is you're paying the decay less, but still paying decay. You're still paying some money up front, and you need a lot of really movement in the underlying for that trade to break even. Now, you can flip that script again, go short, the short strangle, and there's a lot you can do with that as well, but it's the same type of scenario. Instead of wanting the underlying to move between 43 and 57, now you want it to stay put there. You don't want it to break through either of those strikes because you want it to stay there, and you want to collect that dollar on the call side, that dollar on the put side. You want them both to expire worthless. So you're betting there that there may be some movement in the underlying, giving yourself a little bit more wiggle room. It might move around the at-the-money strike a little bit, but you're not as locked in. You're not as tight as you were if you're selling the straddle, where every little tick in either direction really hurts you. With the strangle, you have a little bit more wiggle room, a little bit more flexibility, which is why a lot of people tend to gravitate towards this one versus the straddle, just because it's a little less intimidating, a little less frightening, and a little bit more useful as well. Now, Mike, how is your take on the strangle differ versus the straddle? Do you find yourself employing the strangle a little bit more and perhaps recommending it to your clients a little bit more? Where do you stand on the good old strangle?
Well, it's situational. I think you have to kind of look at what the market is, what your sentiments are. And what Randy had mentioned before with the iron butterfly. A very popular usage of the strangle is a short strangle, a covered short strangle, which is known as the iron condor, has become a popular trade. And the technical term, a covered short strangle, where you're basically selling a spread on a call spread and a put spread. That's a very popular mechanism as far as option traders utilize to create premiums in their trading accounts. So you can go back to our friend the straddle. So when you're pricing, how far you want to be out of the market, whether you're looking at the deltas of the short strikes or whatever indicators you're using for your selection to get into the trades, you can look at the straddle and see what's the implied vol saying on this thing. If it says $12, well, maybe I'm comfortable shorting the 115 calls and the 85 puts in the capacity of if the underlying's at 100. So you can use them interchangeably and vice versa. If you got long the straddle, you could sell the strangle just to where the implied vol cuts it off. So they're interchangeable parts. They're very useful, not only as a trading mechanism but as an indicator as what the market thinks the implied vol is. I was going to interject before about the straddle. Another way to use a strangle straddle mechanism is if you're long a stock and you're going into an earnings report or something else that may make you think, hey, this might not be the best time to just be outright long this stock. If you buy, let's say you're long 1,000 shares of stock XYZ at 100. If you buy 2,100 puts, you actually just created a synthetic straddle. So you've kind of defrayed, some of the catastrophic downside risk. And if you have no idea which way the stock's going to go, the risk is somewhat transferred to a to a price that if the stock really does plummet or really does take off after a report, you shave down a significant amount of risk with by converting your long stock position into a synthetic straddle. The uses are, they're not endless. Obviously, you can't do infinite things with a few strikes and a few positions, but just understanding the different variances and mechanisms of each strategy and how they're interchangeable. I encourage everyone to look into the vast different ways that you can employ the options.
And again, that's one of the reasons why we really wanted to cover these positions on the show today. In particular, take a look at both of them by themselves, not as part of other positions, because you're right, they are so mutable, so pliable, so adaptable to a variety of different scenarios. We just laid out a couple examples of ways you can take these very basic positions and combine them, tweak them with other positions, and make some very interesting type positions. Like Randy just said, the iron butterfly. One of my favorite strategies, sounds like one of Randy's as well. It sounds intimidating when you think, oh my gosh, Iron Butterfly, isn't that a song from the 70s? But in reality, it's just a straddle and a strangle, and there was just different signs on each. So if you buy the straddle, you want things going to move, then you sell the strangle to defray some of the cost of that straddle and kind of clip your wings a little bit so you don't have to pay as much upfront for that straddle, and vice versa. If you sell that straddle and you're really worried, oh geez, what if the worst happens and this underlying really runs against me? Well, then you buy that strangle to kind of clip your maximum profit, or to clip your maximum loss at the wings of that iron butterfly. So it's a very straightforward and very simple and very, very useful type strategy just by combining these two very simple strategies into one type trade. Randy, anything else on the strangles before we move on to their perhaps somewhat more controversial variants here?
Yeah, absolutely. We use the short strangle as a major component of the Swan defined risk strategy. So, just to maybe educate people, we go our strategy is going long ETFs and using long term puts to hedge the downside risk on the indices, and then we sell short term strangles on the same underlying. And so it's a major component of our strategy. Of course, we're betting, we're counting on that to generate profit over time. And it's historically speaking been a very big component of our long-term success at Swan. We think it's a great way to help pay for and finance some of the underlying insurance costs of hedging your downside in your portfolio. I think the last thing I would just compare the strangle versus the straddle. The strangle obviously is a high probability trade when you're selling it. Of course, you have to watch out for large moves in the market. That's where you get stung on the short strangle, and so that's why we at Swan it's really primarily based on probability analysis of knowing what the probability is of you winning on those trades, and when the trade goes against you, getting out as soon as possible to minimize your losses.
So in that overlay strategy, what you're essentially doing there is you're long the underlying, you're buying that nearer term, closer to the money put to protect, and then you're using what we're just talking about here, the strangle, and selling that to generate some extra income and offset even more of the price of that put than you would traditionally see with just a typical collar where you're long the put and short the call. That's usually not going to get the job done to offset the price of the put. So you're adding, I guess, a short put kicker as well into that collar scenario, and that helps you guys to offset even more of the price of that protection over time.
Yes, and the only thing I would just change is the puts that we're buying are much longer term than the strangles that we're selling. So there's also a time decay component of matching up those different positions that have different times expiration. Of course, the underlying has no expiration, but the put options are usually around 2 years to expiration.
Again, taking advantage of what we talked about in the show many times, time decay. You buy the longer options, you pay more time premium, but you suffer less from time decay, whereas you write those near-term options, it's nothing but extrinsic value, and you get a lot of bang for your decay dollar. Now, moving on to some other different ways you can use straddles and strangles. I wanted to include these here on the show today because you may not have heard of them, and they are kind of interesting. Mike kind of alluded to them when he was talking about covered strangles. He was using it in a different context with the iron condor there, but there are other ways you could set up these quote-unquote covered straddles and strangles. I use quotation marks around these because they're not entirely covered. You may be familiar with the concept of covered from the typical trade, the covered call. You long the underlying, you write an at the money, in the money, or out of the money call against it, and you know pretty much what's going to happen. You are essentially covered by the underlying that you hold. So if the underlying rallies and that call becomes in the money, your stock's going to get called away at that price. It's a very simple trade to wrap your head around. But what is the constant quest from those covered call traders, those income traders? Well, they're always looking for more income. That's what they all want. And one way to achieve that is by taking advantage of what we're talking about here, which is the covered straddle or the covered strangle. Let me walk you through a scenario. Let's say, again, you have the typical covered call scenario in XYZ. Maybe you're long from 48 or 50, wherever you're long from. You're long the underlying. And you decide to write that 50 call for $2. You're collecting that. And now you turn around and say, wait a minute, if I also write that 50 put, I'm collecting essentially double the amount of income. I'm doubling my revenue on this trade. And so that is much more attractive to me. Over time, as I continue to do this, I'm collecting a lot more income. Now, the downside to that, quite literally, should become apparent very quick too, which is why I use quotations around the term covered. This is obviously a strategy you want to only employ if you are seriously bullish on a particular underlying, or indeed comfortable acquiring more a little bit to the downside, because in the scenario we just lay out, obviously if the underlying rallies above 50, your stock's going to be called away at an effective price for you of $54 because you sold both options. But to the downside, if those options expire with the underlying below the 50 strike, guess what? You're buying more of it now. And if you're doing it in a typical covered call scenario where you're writing calls and puts on all of the shares you have, you may be effectively doubling your position at an effective price of, in this case, $46. So you have to be very comfortable owning that underlying and indeed acquiring more of it, because over the time of implementing this strategy, you probably are going to buy more. And so it's something, that's why I don't throw this around that much, but it's an interesting idea. And for some advisors out there who are looking for ways to generate more income, perhaps they have excess capital in their accounts that they don't mind allocating towards an additional allotment of a particular underlying, then this is an interesting way to do it, particularly if you can structure it so that you're generating the income to the upside, you're selling that underlying at an effective upside price that you're comfortable with, but also on the downside, you're buying that more of the stock at a price you probably would be buying it at anyway. Maybe you have a limit order working there already. You can instead turn that around and write these options. And indeed, that's why I also wanted to throw the strangle into this conversation. That probably is more attractive for a lot of you because you're probably used to writing out of the money covered calls and buying out of the money puts to hedge. This is the way to take advantage of that. You're going to sell an out-of-the-money call and also sell an out-of-the-money put to generate additional income. Again, same thing like with straddle versus strangle. You're going to generate a little bit less revenue than selling the straddle against your stock. But also it gives you a little bit more wiggle room in the underlying. So the underlying can rally a little bit more to the upside, and you can participate on that. And you also have more wiggle room to the downside where the underlying can drop quite a bit before you actually have to buy more. So that's attractive for people who already have particular setups in mind. And if those prices where you're looking at it and they're not that far away from the at-the-money strikes, and you say, you know, I really would buy some more stock here, and I also would be comfortable selling it here, then it makes no sense to just work limits in the stock. You might as well get paid to do that. And that's why a covered strangle may be an interesting idea for you. Now, Mike, do you employ either of these strategies over there at RCM, either the covered straddle or perhaps it's a little bit more friendly counterpart, the covered strangle?
Yeah, you know, we've got and Mike Tusaw, one of the advisors in our office, has a strategy that we've been managing for, it's been since about 2007, that we call the discretionary option spread strategy, or the DOS. It incorporates a bunch of different option strategies. It's an option-only strategy. There's no underlying. There's no participation in any index. It's just flat-out options every month, and it's discretionary based on the manager's view on the market, the volatility, the sentiment of up or down, and what the impact of the move is going to be. So we'll shift from different types of strategies. It's 100% discretionary. Each strategy has a rule base to it. But 1 month he might be doing a weekly calendar, a monthly diagonal, a front month covered strangle, or a long yearly. And they're playing hockey here again. It's 2-2 in overtime now. Canada tied it up right at the end of the third period, so you're gonna hear some yells, and I can't mute it. But it's 2-2, 19 minutes to go in OT. Go USA, USA. We do employ the covered strangles and the covered straddles from time to time. It's just a matter of we don't consistently do it month after month after month, unless the market depicts that's what we should be doing.
And Randy, it sounds like this is pretty much a primary component of your overlay strategy, except you're adding that additional layer of that much longer term put to add some hedging protection to the portfolio. But other than that, you're implementing this covered strangle on a very regular basis.
Yes, we like the strategy as long as you're aware of the issues of leverage that you already mentioned. As income guys, we, like you said, we strive for as much income as we can get, provided the risk parameters are met. So I think it's a very viable and a good strategy to employ, especially if you like the underlying or somewhat bullish on the underlying, or don't mind the acquiring more shares.
All right, and that's going to do it for our Options 101 segment. And now we're going to keep on rolling into my personal favorite portion of this show. No offense to Randy and Mike, because it's the chance you guys get to join us here on the old Advisors Option panel, because it's time for our listener mail segment.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the listener mail segment. This is, of course, a portion where you guys get a chance to sound off and join us here on the old program. A lot of great questions from you guys rolling in. First one from Mr. Avid Gardener. Guess he's a big gardening fan. And he writes, I'm looking for ways to use options to establish very low cost or hopefully free bullish positions on stocks and ETFs. Is this possible, or are my expectations unrealistic? Any specific strategies you could recommend would be greatly appreciated. Well, Avid Gardener, you're in luck because your expectations are not unrealistic. You can do that using options, and there are a number of different ways you could choose to employ that particular strategy. Mr. Mike, I'll give you pride of place here. What is your favorite way to go about doing what Mr. Avid Gardener asked for here, establishing cheap or just low-cost bullish positions here in an underlying?
Absolutely, and there's no real way to answer this question with the word free, without explaining what the word free means when you're trading options, or really cheap. So really cheap options are called way out of the money options. And if you buy those way out of the money calls, that's a really cheap way of establishing a bullish position. I don't think that's what the Avid Gardener meant with his question. So I'm going to respond to it what I think he or she meant, and that's the establishment of how do I get into positions that I have less risk once the positions are on, or a cheaper look at the upside. And the right way to answer that question is you're never going to get a free or really cheap high probability option trade on without exercising a certain amount of risk that you're comfortable with. Meaning, if I buy an at the money call option because I'm bullish on a stock, and I take the risk that, okay, this stock is going into a report, I'm bullish, I'm going to establish this position, and let's say I'm right, and the stock goes up $10, my call subsequently goes up $5, and I paid $5 originally for that call. I might look at a strike $5 up and sell a call for $5. Now I've established what I think is a relatively inexpensive position. I've defrayed all of my risk because I paid $5 for let's call it the 100 call. I sold the 105 call at $5, but I took that initial risk of owning it, that if it went down, I was going to lose money. But now that I was right, I've established a risk-free position. I've given away some of the upside. So there's opportunity cost. But there's always a way to defray risk, but there's never a way to make something cheap or free without having some risk in place at some point. Um, the scale of risk to reward is sliding, and it's always proportional. Anybody that tells you anything other than that either doesn't understand that, never learned that, or is flat out telling a untruth that free or uh, realistically cheap bullish or bearish positions exist. They don't. You have to take risk in order to establish a high probability, free or inexpensive position that could be lucrative. And Avid Gardener, I hope that helps.
All right, thanks, Mike. And of course, Avid Gardener, there are a lot of great ways for you to really establish bullish positions in an underlying. And before I go on about my favorite, I will give Randy a chance to opine on his strategy of choice, the strategy du jour that he likes to use for doing exactly what you're talking about, establishing cheap, or dare I say it, even free positions in a particular underlying. Randy, do you have a particular go-to strategy you like to employ for this?
Yes. First of all, I think Mike did a great job of explaining the different risk-reward characteristics of any type of position building like this. But I always go with the simplest. I always go with selling some either at the money or out of the money puts. You collect the premium if the market stays or the underlying stays flat or goes up. You're not making a directional bet. You've got a little more, I guess, flexibility on. It's kind of like the concept when they used to say about the forward pass in football. Three things can happen. Two of them are bad. I think the same thing about selling the put. There's three things can happen. Two of them are actually good in your favor in terms of you selling a put. So that's the most simplest and realistic way that I think is to profit from something like that or build positions.
Randy, I knew there's a reason why I liked you, because you and I seem to think alike when it comes to strategies. You like the iron fly, and you also have a similar approach to getting long and underlying. So yeah, Avid Gardener, I take a similar view here to Randy in that is the most basic way. But I also like to combine that into one of my other favorite bullish positions, and that is the bullish risk reversal. Now, it sounds scary. It sounds complicated. If you can handle what we just talked about with strangles and straddles, then you could easily handle a simple risk reversal. What is a risk reversal? Well, it takes what Randy was just talking about, selling typically an out-of-the-money puts, which is something I think most of you are already pretty confident in and have an understanding of. And if you don't, we've covered that many times on the show. Go check out our archives. So you know the benefits of that. Like Randy just said, that is a simple, easy way to generate a bullish position in an underlying. And if the underlying goes your way, you're collecting money for that trade. You're getting paid to do it. So that's even better than a free trade. Of course, you have to remember all the things Mike mentioned about the risk. You know, we have to buy the underlying. But if you're comfortable with that, then the short put is a great way to go. If you are indeed still bullish on the underlying and you want to participate on the upside as well, then you can combine that short put you just sold and use that premium to turn around and buy a out of the money call. And so now what have you done? You've sold a put for some X amount of dollars, and you've typically, if you've structured it well, you've bought a call for usually for a comparable level of premium. Maybe you collected a little bit. Maybe you shelled out a little bit if you really are bullish and you wanted a little bit closer to the at-the-money call, a little bit meatier call. But in general, now what you've done is exactly what you asked for, Avid Gardener. You are able to establish a sometimes very, very low cost, sometimes free, sometimes actually collecting a little bit of a credit bullish position in an underlying. And now what happens if the underlying just sits there and goes nowhere? Well, no harm, no foul. You didn't pay anything for that position, or if you did, you paid a very, very small amount. Certainly far less than if you went out and just bought the stock, or if you even just bought a call. Now, and if the underlying rallies, you get to participate in that underlying rally beyond that strike that you bought. So if it rallies aggressively, then hey, that out of money call is going to pay off for you and it's going to work out for you. And if the underlying drops precipitously, well, then you're going to buy it at that strike that you wrote that put. But as long as you wrote a put at a strike that you're comfortable buying that stock anyway, again, we talked about that many times in the past, you have to watch out for gap risk and all those other things like that. But if you're comfortable with those levels, then this is, I think, an attractive position for you. So take that, what we talked about earlier with the strangle, and just turn it on its head a little bit. Sell that put and buy the call as opposed to selling both or buying both. And then you have an idea of what we're talking about here. As with everything we talk about here on the advisor's option, don't let the terminology fool you. Don't get hung up on the terminology, because it sounds a lot more intimidating than it really is. Risk reversal, straddle, strangles, iron condors, iron flies, these are all very simple positions, despite what their names may imply. All right, next up we have a question from Mr. Istafan. And I think, Mike, you should do the honors here. Why don't you read this one for us?
Yeah, no. So the next question comes from Istafan. Istafan is thinking of becoming an RIA, which is a registered investment advisor, or a CFA, which is a chartered financial analyst. What should I expect on the exams from an options perspective? Any tips for an aspiring advisor? Thanks for the informative program. It has inspired me to pursue this as a career path with an emphasis on options. I have to say that inspiration has to come from Randy because I have never inspired anyone to get into this business. So, Randy, I think you got a fan there. Um, and then to answer the question, the RIA, the exam you have to take is a Series 65 exam, which is the Investment Advisors Act of 1940 state securities exam. There aren't a lot of options questions on that exam. It's more centered around rules, regulations, and prudent man rules, and how the different states look at the different qualifications to be a fee-based advisor. The CFA would cover more of it. I am not a CFA. I have not taken any of the CFA tests, but there's 3 different tests. I don't know which level covers it or if all levels cover it, but CFA exams basically cover anything that has to do with anything that ever existed and could potentially exist in the financial market. So that's a way more comprehensive exam than the Series 65. And as far as any expectation of the exams, I have heard they've gotten a little more difficult after 2008. There's been different scoring, new questions. The percentage you have to get to pass is a little bit higher than it used to be. And then as far as any tips for an aspiring advisor, I mean, when I first got into this business, the best advice I ever got from anyone, and I'm happy to share it here on the show with you, is find somebody that's willing to be your mentor, that has done this business for 10 or more years, that's willing to, grab a coffee with you every once in a while so you can bounce ideas off of them. It's an interesting industry. It's evolving and it's changing every day. It feels like, but the best advice I can give you is to before you dive in, understand where you want to fit within the marketplace, and then find a mentor. Mentors, I believe, are probably the best tool that you could have, whether you're going into another practice or if you're going to start your own business. It's good to ask as many people, but find somebody you know or develop a relationship with somebody, get to know them and trust them, and that they're giving you objective advice to help mentor you into this career.
All right, that's a great answer, great advice there, Mr. Mike. And Randy, obviously, as the other practicing advisor here on the panel, what advice, what tips, what feedback do you have for our friend here, Mr. Istafan?
I'm an RIA. I'm not a CFA. I would argue that if you trade options at all, I think the questions that would come through on the RIA, the Series 65 exam, would be relatively straightforward and easy for you to answer. I think it's been a while since I took this exam, but that's kind of my recollection of how the questions came down.
And any tips for someone who wants to get into the advising business and use options to do it?
Well, I think it's a great idea. I think the ability to get into this area is extremely high. I think this is a growing industry, and so I would highly recommend, if you're interested in doing that, to pursue it. How you do that, I think it's just a matter of delving into the world of options and combining your experiences probably as a normal RIA in terms of the investment world. Add another feather in your cap by learning about options, trade options, attend seminars, classes, books. I think that's the way at least I learned how to trade. I did not come from a traditional trading background. Really, actually, I'm a CPA by trade, and so I came in it from a little different direction.
And that's why I like having you and Mike and even Eric and Alan on the show, is because you guys come from an advisor background, and you don't see more advisors doing this as competition or anything like that. In fact, you actually welcome it because you recognize the value of more people understanding options and using them and presenting them to their clients in a healthy and responsible and safe, risk-mitigated fashion. That's beneficial to everyone. A rising tide certainly does lift all boats in that scenario. So, Istafan, we wish you luck. And certainly if you have been able to follow this show since its inception and all the concepts we've outlined on this program, you should be able to handle anything, at least from an options perspective, that they throw on you, or excuse me, that they throw at you on either of those two exams. So I think if you listen to this show, listen to the archives, maybe listen to a few of the other programs on our network that are educationally oriented, you should be well armed for the options portions, at least, of those two different exams. All right, and last up here in the old listener mail segment, actually, Randy, this one's for you. You have another, despite what Mike said, you have another fan here on the show. This one comes in from Inwi06, I don't know, however you want to pronounce that. And he writes, quick question for Randy. Just what is reinsurance? We got actually a few of these trickling in, Randy. I know you've mentioned it, and Mark has as well on your appearances in the past, that amongst the many things you're doing over there at Swan, including the overlays and other stuff like that, you're also dabbling in the reinsurance game. So why don't you go ahead and give our listeners a quick overview of just exactly what the heck that is.
Okay, I'm going to start off with what I think is a brief definition, then I'll go give an example, which I think will be a better way to try to explain what reinsurance really is. Reinsurance is really assuming risk from other insurance companies in exchange for premium. So what you end up doing is collecting $1 of premium, you put up the reserve on the books, you pay out those claims over time, but you're not the reinsurance company is not the insurance company that's originating the business. They're usually assuming it from another insurance company. So to give you an example, let's assume that you want to build a building in downtown Chicago, make it the tallest building in the world. And typically what's going to happen is there's going to be an insurance company that's going to insure that risk, but they're not going to want to have all that risk out there. They're going to go out and find other insurance companies and other reinsurance companies that are going to share some of that risk. So it's just a way to diffuse or diversify the risk that any underlying insurance company would actually take on to minimize their risk. I use the analogy all the time. I think the reinsurance market is very similar to the options market. The reinsurance market is a little more relationship driven in terms of there's not as many transactions, but it's the same concept of accepting a certain level of risk for the premium that you collect. At Swan Re, what we're really trying to do is combine a option-based, low volatility strategy, the defined risk strategy, and put it inside a reinsurance company that uses the premium float to invest in our strategy and pay out those claims, over the next 3 to 5 years. So in our particular example, we're trying to combine two very low risk strategies, the underlying side as well as the investment side, to really hopefully give investors the potential for pretty sizable returns in a tax-deferred manner, since Swan Re is actually set up in Bermuda.
And I think, listeners, you can see how that dovetails back into options. I mean, options in their most basic level, their most basic component are indeed insurance-type products. You're using it to insure an underlying portfolio or insure against a movement in a particular underlying or things like that. So at their most basic concept, options are insurance, so it dovetails well into the reinsurance market, perhaps a little less liquid than the listed options market, so you kind of have to pick your places probably a little bit more strategically, but that's where that options wherewithal comes in. But other than that, INY06, it's very similar to all the things we talk about here on the show, just in a little bit different marketplace, but applying that same risk management, risk mitigation techniques that you may use in an options portfolio to help mitigate this insurance risk. All right, guys, great questions. Keep them up. That's all the time, unfortunately, we have on this episode. But if you'd like to make your voice heard on the old listener mail segment, a lot of great ways for you to do that. You can follow your fellow listeners here and surf on over to theoptionsinsider.com. Post a comment on the show notes there on the website. Of course, you can find us the old-fashioned way on email. Just send an email to questions@theoptionsinsider.com. Just be sure to put in the subject line, question for the advisor's option, so we know where to send that question. Of course, you can also find us on social media, twitter.com/options. A lot of you guys love to tweet in with questions. Also, facebook.com/theoptionsinsider. And last but certainly not least, you can also do it from the mobile app. So if you've downloaded that on your device of choice, to click on that contact tab there. It's either in the individual shows there on the Android and Amazon versions, or in the iOS, I believe it's a separate tab. You click on contact and it has all the stuff in there. So whichever version you have, you should be able to reach out to us via the app as well. A lot of great ways for you guys to get in touch with us here on the Advisors Option Program. And I want to thank my cohorts for joining me. Mike had to leave a little bit early, so if you want to learn more about what they have cooking, then head on over to rcmwealthadvisors.com. You can find out all about what they're working on over there at RCM. And Randy, of course, we just talked about the reinsurance project. That is kind of the big to-do over there in Durango these days. So why don't you give us an update on that and what else you got cooking over there at Swan Wealth Advisors?
Well, we actually launched the company in January. We are in the process of doing all the necessary corporate governance type stuff and expect to start underwriting this month in February. And the capital raise is going reasonably well, and we're excited about the opportunities going forward. That's really, as you said, the new latest and greatest at Swan Wealth. Otherwise, everything else is growing at pretty respectable levels, and we're excited about where we're at. We've really grown a lot from the size of Swan, from about 4 employees to about 10 employees right now.
And typically we send people to check out the swanwealthadvisors.com. That's kind of the go-to knowledge center. Can they also find information about the reinsurance there as well?
Yes, we have a product page. There's actually an interview that I did for a financial publication that it's about a 15-minute interview that goes through all the normal questions that people ask about Swan Re. It also discusses our other product, and you also mentioned the knowledge center that we have that has a lot of our literature that we put out on a monthly and quarterly basis.
There you go, listeners. Surf on over to swanwealthadvisors.com if you, like INY06 there, any others, want to learn more about either the Swan Re or what they do actually with the risk overlay and all the other fun stuff they have cooking over there at Swan Wealth Advisors. And on behalf of Randy and Mike and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and, of course, for sending in such great questions. Keep it up, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.